Hello there, welcome to another live webinar with us from Phillip Nova. Today, the topic of discussion is towards the sea of opportunities. And what will we be covering today? Well, let me tell you, Southeast Asia and India are poised to become the fastest growing regions globally over the next decade, amid the burgeoning internet industry and the rise of tech unicorn companies. On one hand, the relocation of the global industrial chain is set to catalyze the development of high-end manufacturing and the electronic technology. On the other hand, the expanding middle class, spurred by the urbanisation and increasing income levels, is driving a growing diversity in internet services and digital consumption demands. This landscape has given rise to tech companies such as SEA Ltd and Grab. Join us as we discuss the market outlook and unique investment opportunities with 30 leading technology firms across six Asian, India, and Southeast Asia markets. Do not miss this session. There'll be lots of insights shared by our speakers. Let me tell you a little bit more about them. We have Bruce Chung, CFA. He's a portfolio manager with CSOP Asset Management. Mr. Chung Ding Hai, Bruce, as we know him, is a portfolio manager at CSOP, CSOP, and is responsible for bond, REITs, and money market investment strategies. His major responsibilities include bond portfolio management and business development to enhance the company's fixed income strategies. And next, we have Raphael, if you have attended our webinars regularly, you know we have spoken to him before, or we've had him in our live webinars previously. He's Raphael Go, intermediary sales for CSOP Asset Management. And at CSOP, Raphael oversees the ETF investment solutions for brokers and wealth managers in Southeast Asia. Raphael is also part of the team responsible for developing sales strategy and strategic partnerships with intermediaries in Singapore. Prior to joining CSOP Asset Management, he worked at Tiger Broker Singapore, where he led several business development functions, which includes products and partnerships. Without further ado, let me hand the time over to Raphael to take us on an introduction section. Raphael, please.
All right, thanks, Sri, and good evening, everyone. Thank you for taking your lovely evening to spend this time with us as we share on the updates on the current market trends as well as what the opportunities are within the Southeast Asian region. So next up, I would like to take this opportunity to thank Phillip Nova for hosting this as well. Great to be back here as well. And here with us on the line today, we have Bruce. So Bruce himself, as Sri have shared earlier on, he's a portfolio manager based in Singapore. So Bruce himself is also the manager for the relevant portfolios such as our SEA Leaders Index ETF, as well as the world's largest China government bond ETF out there in the market. So without further ado, I'll pass the time over to you, Bruce.
Thanks, Raphael and Phillip, and good evening, everyone. So today our topic is towards the sea of opportunity, the CSOP IH Southeast Asia Plus Technology Index ETF. And here C means great opportunity, but also the short abbreviation of Southeast Asia, and plus here means India. So we like these Southeast East Asia and India story, mainly because of their continuing capital inflows. So my presentation will briefly divide into three parts. First, we'll talk about why Southeast Asia plus India. And second part is that why we focus on the technology names in the region. And in the third part, Raphael will spend more time and highlight more colors on our ETF products as well as the benchmark we are using. So first of all, why Southeast Asia plus India? We believe the both regions have the greatest potential to create the next economic miracle, because now global investors and corporations, as they are looking for growth, everyone is wondering where is the next China. And someone says ASEAN could be the supply chain of the world, so new China could be ASEAN, while others says India will have the biggest and fastest growth rate in the coming years. as the nation will have the greatest transformation as compared to other countries in the world. So next, China could be India. So that's why we combine the stories of both regions to capture these great opportunities. And in fact, we over the past 10 years, we have witnessed the startup booms in Southeast Asia. For example, back to 2014, there were only two unicorns. One is Grab, everyone is quite familiar with, and the other one is VNG, the Vietnamese firm focusing on online games. But back to 2 years ago, there were already 46 unicorns in the region. And someone may ask, why don't we directly invest in the US tech giants or China tech giants? And our argument point here is that even for those US and China's largest technology firms, they also spend money investing in those Southeast Asian Indian unicorns, such as Grab, SEA Ltd, or even Gojek and VNG. So that highlights the attractiveness of these local firms. And here, those investors from the US or from China, they not only act as an investors providing the funding, but also would like to replicate their success or replicate their model into the Southeast Asian Indian regions. And these are also echoed by a very fast growth in terms of the venture capital and private equity investment. And as you can see here on the left-hand side, the greater the PE investment into China, their growth, the absolute level doesn't look bad, still okay. But as compared to India and Southeast Asia, now the regions have a much faster growth than China. And more importantly, this kind of fast growth in terms of PE and VC investments is obviously driven by the technology-related sectors. And also for those global largest corporations like Apple and Samsung, they're also relocating their supply chains to the region. For example, Apple is to shake up the international sales operations to make the India its own region, and its next MacBook production center is likely in Thailand. And for Samsung, it is building a US dollar 1.3 billion EV battery plant in Malaysia, and also increase its investment in Vietnam. I think here the story behind these kind of relocations that at the very beginning or in early stages, the local, let's say technicians or engineers in Southeast Asia or in India, they may be hired by those largest corporations elsewhere. But after several years of the working experience, they may leave to join a local firm or even run their own business, and launch some firms can finally becoming the competitors versus those global technology giants. And this kind of relocation was also echoed by a very strong overall FDI inflows. For example, back to 2 years ago, the FDI in Southeast Asia rose by more than 40% to US dollar 174 billion, which is actually a pre-pandemic record. And this the ASEAN remains a top recipient of the FDI in emerging markets and continue to be an engine of the growth. And this kind of strong flows push the FDI stock in the region up to more than US dollar 3 trillion, an increase of over 70% from 2015. So it is not surprising to see the regional market leaders emerging. Now the region has its own version of the Alibaba, such as SEA Ltd, mainly highlighted by its Shopee, the online sales platform. And also the region has its own version of the Uber, such as Grab. And the region even has its own version of the Starbucks as well as the Netflix. So quite a lot of local unicorns are emerging. And investors, when we talk about, say, let's say SEA Ltd or even Grab, some investors may still not quite happy with their year-to-date earnings results, but this is actually well within the expectations, because if we look back to 3 years ago, those firms actually experienced a very fast growth in terms of the volume, the GMV, and moving to 2021, 2022, it's more about a focus on the profitability. And moving to this year, it's more of a balance of the GMV as well as the profitability. So some of the firms has already turned their break-evens, like the SEA Ltd and Grab is also anticipated to achieve its break-even, let's say next year, because those firms already have very dominant shares in the regions, which means if the macro growth is back on track and if the Fed finally takes a breather, and those firms can easily quickly rebound in terms of their local revenues, thanks to the better fundamentals and thanks to the much stronger emerging market effects. So from this perspective, we're still constructive on those firms' share prices. And in fact, after launching our products, their stock price, although a bit volatile, but they already managed to rebound from their recent lows. And in the second part, we'll focus more on why technology names in Southeast Asia and India region. And because we believe there are two angles or two major themes which can support these great opportunities. And one is the industrial train relocation, mainly reflected in the robust export and foreign direct investment. And the other part is the internet adoption. This is mainly driven by the demand for services such as the e-commerce. And both themes actually on the back of the region's favorable demographics, such as the sufficient and cost-efficient labor forces, as well as the macro growth and the rising income levels. And in terms of this industrial chain relocation, if you can look at this chart, the total population of SEA, Southeast Asia plus India, it's already exceeds 2 billion, or 1/4 of the world total population. And for the working age population, now its total working age population is 1.4 billion, which is already equivalent to the total population of China. But the region's median age is just 8 to 10 years younger than China, and their minimum wage is just about half of China. So whether from a number of the labor supply or from a age or from a wage perspective, the region's the labor resources are quite competitive as compared to China or even other countries. So if we combine these competitive labor force and combine this story with the rising labor cost elsewhere, or the supply chain concerns, or even the geopolitical tensions, these actually form the main drivers for the international businesses to further diversify their manufacturing into the ASEAN or Indian region. And this kind of move are also warmly welcomed by the region's countries, such as the tax incentives or some ease of the access. And it's also interesting to note, actually, within the ASEAN, or including India, the different countries within the same region, they have a different levels of the in terms of the macro or economic developments. For example, Singapore, they can still focus on their strong strengths in terms of service or high-end manufacturing. But in terms of Malaysia and Thailand, they can emphasize more on the mid-end manufacturing and gradually transit to a high-end manufacturing. And in terms of Indonesia and India, they still have a lot of capacity to expand their current supply chain offerings. And for countries like Vietnam, they can still leverage their labor cost advantage. So different countries can leverage different opportunities for these great relocation opportunities. So that's why we believe the current industrial relocation actually represents the fifth industrial transfer back to, let's say, 170 years period, because the first round actually happened from the UK to US until the end of the World War II. But then the second round is mainly from US to Japan, mainly from 1950 to 1970. And third round is from Japan to 4 Asian tigers, mainly 1980s, 1990s. And the first round actually happened over the first 20 years in the 21st century, from 4 Asian tigers to China, and now it's turned from China to Southeast Asia. So now it's definitely the region's turn to capture this great opportunity. And this has been reflected in a surge in the exports from the region, but mainly led by high-tech sectors, because the previous impression is that the region may focus more on those labor incentive related or lower-end manufacturing or lower-end products. But if you look at the 2021 top 10 export items, these has mainly emphasized more on the middle-end or even high-end exports, led by the electrical machinery as well as the equipment and parts. So it's quite this kind of development is quite encouraging, which means the region's value add chain is gradually shift to the technology or technology related sectors. And in terms of this internet adoption, which is actually linked very closely to the region's macro growth picture, because now the combined GDP of the SEA plus India already surpassed Japan even back to 6 years ago, making the region the world's third largest economy next to US and China. And even India itself, their macro growth is anticipated to outpace China, with this GDP more than doubling from US dollar 3.4 trillion to US dollar 8.5 trillion to become the world's third largest economy in roughly 4 years' time. So specific to this year, even some investors still concerned about the potential slower growth across the globe. The India, even for China, they may still struggle to maintain a 5 or 5.5% growth. But comparatively, the India, as shown here by the orange bar, and also the Southeast Asia, as shown here in perhaps it's a blue or purple, yeah, blue purple bar. These two regions still are leading the way in terms of the global growth. So it's quite a very strong growth driver this year. And we believe the one direct result of the fast macro expansion is actually the rising income levels, and in turn the booming middle class. For example, the urbanization rate among Southeast Asia and India, except for Singapore, of course, still has plenty of room to improve. And GDP per capita across the ASEAN region will grow by 4% per annum. And the region's middle class is actually exploding to the point that it will include nearly 70% of the region's total population in 7 years' time from now. And these will contribute 140 million new consumers, representing 1/6 of the world's new consumer class. So it's not surprising we'll see more and more crazy rich South Asian or Southeast Asian in the region. And if you combine this rising income level or middle class story, and together with this large young population and the rapid growth internet users in the region, these actually provide a huge client base for the development of the digital economy in India, as well as the SEA leading economies such as Singapore, Malaysia, Thailand, Vietnam, as well as Indonesia. Because on average, their internet penetration rate is still relatively low. Maybe the next target is to catch up with China, which is at around 70%, and the next the following target would be the United States, which is at more than 90%. And according to a report together done by the Temasek and Bain Company, these regions are fast. The internet sectors has been growing very fast, and is expected to grow fast in the next couple of years, still maintaining a let's say double-digit growth. So this also echo this fast internet user growth story. So if this happens, the strong economic growth leading to a booming middle class, and finally leading to a huge and fast-growing internet users, this would generate great demand for the internet services such as e-commerce or the online travel, online media, ride-hailing, and food delivery, as well as the fintech. And perhaps someday even Phillip Nova can be classified as the fintech name, and we can invest in them. And
Sounds great, man.
yeah, there's also a great demand for the global IT outsourcing. No doubt, India has been #1 IT outsourcing destination for more than 16 years, but Vietnam and the Philippines also emerging to be the global top popular IT outsourcing destinations. That's also one of the key reasons we include India into our portfolio in addition to the ASEAN countries, because now more than 500 companies in India are offering the outsourcing services to over 66 countries, and half of the global Fortune 500 firms are outsourcing their IT development to India alone. So that's why there are a lot of Indian tech giants emerging, such as Infosys as well as Wipro. And this slide is actually a quick snapshot of our top 10 holdings of our portfolio's benchmark as end of March this year. We already conducted our index rebalancing in June, right before our product launch, but the top 10 holdings are pretty much the same. Here you can, as you can see, we have the SEA Ltd or Grab, which everyone should be very familiar with, but we also have some regions tech leaders in different countries. For example, data electronics, which is closely linked to these AI investment themes, because they produce the AI servers for those related data centers or other producers. These actually the revenue is 3 to 4 multiples as compared to the traditional servers. And we also have some firms which used to be classified as a traditional manufacturing firms, such as Astra International, even their parent Jardine Cycle and Carriage, because they have a very close linkage to the electronic vehicles production and as well as distribution. So they're also in our top 10 holdings. Again, we have the Indian tech giants, Infosys and Wipro. We also have the Singapore firm Venture Corporation, focusing on some high-end manufacturing. And we also have some boutique names, which has a unique market position in the region. For example, we have the Indo-Malaysia Netflix, Imtech, in our top 10 holdings. We also have the India's the Expedia, the Make My Trip in our top 10 holdings. And in addition to the top 10 holdings, we also have some boutique names in different market segments and listed in domiciled in different countries in the region. But roughly speaking, the stocks linked to the internet adoption or the consumption story, it's slightly more than 50% in our portfolio, and securities related to this grid industrial chain relocation, it's also nearly 50%. So roughly half in our universe. So that's why that's how we tend to capture these great opportunities going forward. So perhaps I can pause here and move to the third part, which our colleague Rafael will cover why investors should consider using a CSOP Edge Southeast Asia Plus Tech Index ETF to access these great opportunities. So now it's your turn, Rafael.
All right, thanks, Bruce, and thanks, Sri. All right, so Bruce, if I can trouble you to refer to yes. Right, so I think the main proposition that we have today for you guys on the ground is that this is also the first ever Southeast Asia plus India technology focused ETF out there in the markets today. And by traditional methods of selection, most funds out there actually would consider the country of listing as a main priority. But on our end, this IH Southeast Asia Plus Index was actually customized by CSOP as well as in collaboration with SGX. We actually liaise with them and have this index customized. So first of all, we don't believe that it doesn't necessarily mean that the India company has to be listed in India to be part of the selection pool. So with regards to that, we actually chose the most logical method by putting in the eligibility should focus on the country by company by domicile. So meaning to say companies, they have to be headquartered within India or the Southeast Asia region to uh, be able to be selected within this selection pool. Secondly, I think on the other spectrum is that we also focus on a very, very broad spectrum. So looking at the coverage, we cover the business services, consumer retail, consumer vehicles and parts, electronic components, manufacturing, food staples retail, hardware, as well as industrial services. But do take note, all of these are just key factors that we do factor in, but more so that we also focus on the key revenue of these companies. More than 40% of the company's revenue must be tech related in order to be eligible for inclusion. And for tech related revenue thresholds, for it to become a new selection pool, they have to be at least 50% of for new conglomerates. So of this, we also take note of all these markets situations within the Southeast Asia region. We understand that certain Southeast Asia markets, it may be not that liquid, and thus we also incorporated a free float adjustments or threshold for new constituents 12% and 10% minimally for existing constituents. Next up, we also focus a lot on the velocity threshold, meaning the turnover itself. It has to be 0.1% for new constituents, at least 0.08% for existing constituents. So what this actually means is that we also keep selected the top 30 weighted by market cap, the top 30 tech companies within the Southeast Asia plus India region, and they will be weighted accordingly based on their market cap. And next up, in order to capture, while we understand that within the region, more and more, we keep seeing upcoming IPOs and all these unicorns being listed on the relevant exchanges. It may be over on the US, you may be over in the Hong Kong, it may be over in Singapore. We also keep an eye out for such unicorns IPOs listings. So we also incorporated a fast entry rule with regards to this index itself. So any newly listed unicorn companies, as long as its market capitalization is actually the top 10 of its first trading within the top 10 holdings of this index itself within the first trading day, by as soon as 10 days, this new company will also be incorporated within the index itself. So this index, he also rebalances every March, June, September, and December. And just take note, because of its exposure towards some EM markets, the index currency currently is weighted based on US dollars. Its base currency is in USD. So do take note of some FX risk that we are actually undertaking. But nonetheless, this is being based in US dollars to allow us to facilitate the relevant
So I guess the Raphael's your line's a bit disconnected, but I'll try to follow up with this Raphael's slides because they just finished talking about the benchmark. Now we can maybe spend more time on the benchmarks breakdown. Maybe Raphael is back. Perfect. Yeah. But I still can't hear you. Maybe I can wait until you are back. Yeah. Can you try again? No, we still can't hear you. But maybe before you fixed it, I can still continue with your introduction, because simply speaking, the by country of listing, we do have the Singapore, Malaysia, Indonesia, and Thailand, but we have more than 40% of the US listed stocks, but they are mainly comprised of the Indian companies through these format of the ADRs. We also have some Singapore domiciled names such as Grab, which is listed on Nasdaq, because we believe on those US stock markets, we can have a better access to those stocks liquidity, in particular for the Indian firms. But from a geographical revenue perspective, the the revenue source are still mainly from the Southeast Asia countries, for example, the Indonesia, India, as well as Vietnam, Thailand, as well as Malaysia. So from this perspective, given this highly diversified underlying country revenue source, then definitely even a single country's slowdown may not prevent the whole ETF, the whole portfolio from rising in the longer term. And in terms of the sector breakdown, no doubt the electronic components as well as the software are still dominating this technology portfolio. It seems Rafael is back again. Can you check if you can try to speak up? No, we can still not. We can't hear you. And in addition to those traditional tech the names, we also have these retail names because now more and more retail firms, they invest money in the technology related sectors such as the online apps. So that's why their revenues are more and more linked to these technology. So that's why we have those retail names to link to not only to link to these the region's manufacturing story, but also linked to the region's growth or consumption stories. And here it's a historical performance of the benchmark we are using. As you can see here, over the past 5 years, the red line, our IH Southeast Asia Plus Tech Index, they used to perform in line with a more generic MSCI Emerging Market Index in orange color. But after this outbreak of the COVID-19, those technology firms actually experienced a surge in terms of their performance. This is not surprising because after this lockdown, investors or people or consumers are relying more and more on the online apps or technology-related apps. So from this perspective, that's why over the past 5 years, actually the Southeast Asia tech performance is actually in line with the Nasdaq 100 index. So that's why over the past 3 years, this annualized return, it's nearly 45%. And even we expand this investment horizon to 10 years ago, it can still achieve a double-digit return, which is more than 10%. So here I want to highlight that for investors, actually this is not a dividend product, because the underlying firms are mainly growth-driven firms, growth-oriented. So which means their long-term potential is mainly reflected in their capital gain potential. So this can also justify a relatively high standard deviation or high volatility. So from this perspective, even they have a high volatility, this can be compensated by their high historical return. So that's why they have a relatively high Sharpe ratio, and their current drawdown, it's already at a relatively low level versus the history level. So which means these Southeast Asia technology names still have room to rise further from the current level. This is because from a valuation perspective, as compared to Nasdaq 100 stock index, the Southeast Asia tech has a slightly higher price to earnings, but it's justify a much faster EPS growth, let's say in the next year. And as compared to some China onshore technology names, it has a lower PE, cheaper valuation, but has a quicker EPS growth estimates in the next year. So that's why it has outperformed the China onshore or the Nasdaq 100 stock index over the past roughly 3 years, but it may continue to do so if their earnings can be kept resilient in the next couple of months. So this slide is actually a snapshot of CSOP Edge Southeast Asia Plus Tech Index ETF. As mentioned by Rafael, we have SQU, the US dollar counter. We also have the SQQ, an SGD counter, which means investors can easily trade in either counter and can switch without any other processes. again, we launched this ETF back to roughly one month and a half ago on June 23. And our underlying base currency is US dollar, which means if the stock price are unchanged, the fluctuations between the underlying emerging market FX and SGD versus US dollar can still impact the counter's performance. And the trading lot size, it's one share, which means investors now can start to trade these ETF shares theoretically from around slightly more than $1 level. And we use a passive management strategy, try to replicate the benchmark, and the management fee it's slightly below the 1%. And custodian side, we use the DBS Trustee Limited. And some investors may be curious why investor management fee is not quite low, but I think it's quite normal because we are investing in mainly the emerging market equities, focusing on the growth stocks, and these high management fee means that we can help investors access the underlying liquidity. Means that investor doesn't have to open the trading account for each single country, particularly for those emerging market countries, and investors don't need to suffer a relatively wide bid-ask spread, because we have a dedicated investment and trading team can help lower the bid-ask spread and lower the commission for investors, and directly transit this saving back to investors. And this can be reflected in a relatively tight bid-ask spread for the ETF as compared to the direct investments. And also the potential high capital gain potential and also relatively high volatility can also justify this relatively high management fee. And this can also echoed by these two counters' performance since its listing, because even back to roughly 2 weeks ago, the both counters has already surpassed their first day EOD price level. And during this week, actually the SQQ, the SGD counter, it's already surpassed their LP price, the $1 per share, up a few percentage during this peak price over this week. So from this perspective, we do believe if the Fed has been is becoming more friendly, and if the region's economy can be more healthier and translating to a better earnings result, and then these Southeast Asia and Indian technology names can still have room to go in the near term. And in the middle to long term, it's more about this strategic story we have been talking. It's more about industrial relocation and the internet adoption stories. So that's pretty much concludes our presentation today. So maybe we can pause here to see if any questions, and also we can spend some time to see if Rafael can manage to get back to this conference.
Yeah, can you hear me now?
Yeah, we can hear you.
All right.
Yes, we can.
Thanks, Bruce. Thanks, Bruce. Thanks, Ree, for hosting and sharing. And for the guys on the ground, I understand that Nova side, you guys trade futures, mostly futures contract. Am I right to say that, Sri?
Well, yes, we were originally a futures and forex company. We have
Yeah.
since expanded to offer stocks, ETFs, and CFD as well. Yeah, so we've evolved over the years, and I'm very, very happy to host this webinar featuring CSOP and to tell us about this very exciting product.
Yeah, so my understanding is also these days on the future side of things, the Nifty 50 contracts is also very, very popular. That's what I've heard so far. So for the end guys who's watching here, like actually in India market, it's more so of the de-risking from most corporates. Rather, they would not want most of their manufacturing be concentrated within China itself, namely because of they are afraid of the taxes imposed and the trade restrictions imposed by the Western nations. So definitely it only makes sense for them to diversify some of these supply chains out within the region. And if they were to diversify the supply chain out towards the region, then we will be able to see jobs being created. And that would definitely bring about new consumer segment of the middle income segments within the region. And then again, when we see such a movement of this industrial change, definitely those that have a better job definitely will want to have a better livelihood and a better lifestyle and such. The moving from the non-urban area towards the urban area, the population will seemingly increase over a period of time as well within the region. And with this, we will definitely see a uptake of the internet usage. And with the internet usage, definitely there's a lot of things that we could actually capture, be it the payments segments, the online ordering of food, groceries, even transport. These are some of the key areas that we are also looking at, because this is not something new. Just look at how back then where China was at, maybe just over the last decade, you can see that how fast where they started their movement of their manufacturing going stronger, and the urbanization of China. Definitely this is one key segment that we should be also keeping an eye out for within the Southeast Asia plus India region. So we are still at the very early stage of this transition, and more so is to I would say for those out there looking to diversify out your portfolio, if companies out there are already doing it, so does it make sense for you to also consider diversifying some of your investments out there to prevent itself getting hit hard by all these restriction in place by relevant governments or relevant geopolitical risk? So these are some of key things that I think um, these days, be it individuals, investors like us, we have to really keep an eye out on. And also, I think this is something that we need to ponder about and how to deploy our funds going forward. And seemingly, on the US side of things, you can see the interest rate environment is still relatively at the elevated levels, and the economy is still relatively strong. So this is something that we also have to keep an eye out for, be it whether will there be any pullback, because the US side of things, we have seen the climb over the past month of the relevant S&P 500, be it Dow Jones Index as well as in Nasdaq index itself. You really see that there is really a strong, strong I would say rebound. And now just keep an eye out for as investors, we need to look out for where is the next opportunities, and where should we diversify some of our funds, locking it into certain profits, and then where should we deploy our funds at. I think this is one of the key things that we should be keeping an eye out for when deploying funds. So we are happy to take on any questions. If you have any questions, just feel free to type inside the questions box, and then we will try our best to answer it.
All right, Rafa and Bruce, just to give some time for the audience to type in some questions, I have some questions for you. Based on what we've shared today about the IS Southeast Asia Plus Tech Index, what would you say would be the key takeaways for today's session?
Maybe I can just summarize some key takeaways. I think from a long investment perspective, the region, the Southeast Asia plus India region, they're actually benefiting from this industrial chain relocation, as well as this internet adoption, the grid schemes. I think that's one thing. And secondly, the region's technology firms, like what I've seen from the Nasdaq or even from the Hang Seng Tech story, they are not simply a tech investment schemes, but linked very closely to the region's, let's say, high-end manufacturing as well as the consumption stories. That's why we are constructive on these region's technology investment schemes. And thirdly, it's about investors. Of course, investor can conduct some direct investment in certain names, say Singapore listed names or even some US listed names, but it's still hard for investors to access a full range of the investment across different emerging market countries or their stocks in the region, or even they can access, they may suffer from a higher trading cost. That's why we do believe an ETF vehicle should be in place to help investors to achieve a diversified exposure with a relatively let's say efficient or sufficient liquidity, so to help investor to access this market.
Yeah, I just want to add on to Bruce on this, and we understand the other portion is that seemingly stock picking itself can be a bit challenging, especially looking at the Southeast Asia region, these emerging markets as well as India region. Individual stock picks itself definitely it is a real, I would say, at this current juncture, it can be a real gamble. But nonetheless, with the assistance of ETF vehicle, you'll be able to get a diversified approach. And at the same time, based on this rule-based approach, you will be ensured that you get the best selection pool out there in the market, because at any point of time in the rebalancing phase, if these certain companies they don't meet certain criteria, it will be removed from the index. So there is a beauty about ETF itself, is that it really gives you the rule-based approach and getting the some of these companies that um, it's not easy to access in this current market. Also not easy to understand whether will these companies be feasible or not going forward. But with a rule-based approach and using an ETF vehicle, you get yourself a diversified portfolio in a space of growth.
All right, thank you so much, Bruce and Rafa. My next question is why Southeast Asia plus tech companies? Why is that something that we should be looking at as an ETF?
Yeah, I think as we mentioned in our presentation, I think we do believe the Southeast Asia plus in the tech, this kind of unicorns or technology names, they are experiencing what China has been experiencing 10, 20 years ago, or even they are experiencing what US has been experiencing 30 years ago. And we do believe Southeast Asia and India perhaps is the, now, I won't say the last chance, but currently is the definitely the one of the fastest growing regions in the world, and they are also benefiting from the continuing relocation. Some is because of the labor cost consideration, and some is because of the diversification purpose on the back of the geopolitical tensions. And thanks to the region's still very balanced, let's say the population structure, and also the for example, the gradually higher the education level with a very broad, let's say, the English speaking community. For example, in India, there are a lot of English speaking engineers, and this so as to some countries in Southeast Asia. So the region actually has some unique advantages to capture these relocation or this consumption, the story. So that's why these kinds of technology names perhaps can be the next Nasdaq or even the next China or Hang Seng Tech.
Yeah, so to further add on this, we also experienced like what Bruce has shared earlier on, with the relocation of some of these supply chains out from China itself towards the rest of the world, be it Southeast Asia. We also see it bringing about jobs being created, and with a booming middle class, definitely with the booming middle class as well as the urbanization side of things, technology plays a big factor in improving the I would say the lifestyle or the livelihood of individuals out there in the market today. So definitely we'll see that in this space is something that we should be looking at to embrace itself, and also to capture the growth within the region as the middle class grows, as well as the people with higher disposable income livelihood. You'll be able to spend more, you'll be able to want to be able to improve your lifestyle. When with the help of technology, these are the key nuances that will help bring about a better livelihood for them.
All right, thank you so much, Rafa and Bruce. So just to touch back on this double-barreled question. Okay, so we're talking about tech companies and we're talking about Southeast Asian plus India tech companies. These are pretty new markets, hence they are emerging markets, right? So what would you say to investors who are keen on the product, but like wondering about whether but there's a lot more risk to these products, when you're investing in emerging market technology sector.
Yeah, we love this market segment because we think they represent a unique, fast-growing opportunities as compared to China or even compared to the US Nasdaq. That's why even they have a relatively high volatility, or you can say it's high risk. It's justified by their great growth potential as shown in the history, and perhaps in terms of in their future earnings estimates, and they're still relatively cheap valuation. So that's why we love this unique segment. And also I want to highlight again that based on our highly rule-based approach, which means we'll always tends to include the winners during each quarter, which means for those stocks which can gaining the market share, gaining more traction, they will represent a higher market weight in our portfolio during every quarter and between each quarters. Of course, we still cap the single stock at 10% to ensure diversification and to mitigate the risk. But for those losers with smaller market shares or even a smaller or lower liquidity, then they may have a smaller market weight or even be kicked out from the index. So through this quarterly rebalancing, through the fast entry rule, will always tends to capture this great opportunity by including the winners, overweight the winners, and underweighting the losers, or even excluding those losers, to make sure investors could capture these opportunities while we try to balancing the risk factors.
All right, that makes a whole lot of sense. All right, so Bruce, I believe you have touched on this earlier. So is Southeast Asia Plus, are all these companies listed in Southeast Asia?
Not exactly. As you can see here, we would, in terms of the country domicile, we do have six countries: India, Singapore, Indonesia, Thailand, Vietnam, and Malaysia. But in terms of the country of listing, we don't have stocks listed on Vietnam or listed in India, but our exposure to those firms are mainly reflected in the United States, mainly through the format of these ADR. So this is because they provide easier access with sufficient liquidity. This is how we can help investors to access those markets. But again, in terms of the country domicile or in terms of the geographical revenue, we still those firms are still, or the revenue is still dominated by the Southeast Asian countries. But again, those firms, since they are becoming their size are becoming larger and larger, and their business are more international than the domestic business, then their revenue is highly diversified, which means even for Indian company, their revenue can be from the United States or from the Europe or from China. So from this perspective, we do believe this diversified revenue source can help investors diversify the risk. But the selected country of listing can also mitigate some liquidity risk when investing in this portfolio.
All right, thank you, Bruce. For Tanvi, I missed out on your questions in the question box. These are some great questions. Thank you for sending them, so we all can learn from the insights to be shared by our speakers. All right, first question is, you might have touched on this briefly. This question from the audience is, what risk do you foresee in this investment aside from FX risk?
I can start from there. In addition to some FX risk, I think the other two risk is mainly the market risk as well as the liquidity risk. So in terms of market risk, which means most of the underlying holdings, they are still the growth stocks. Of course, they may have a great potential to achieve a very huge capital gain, but in a certain time or in the short term, they may still subject to some high volatility, may be subject to the policy uncertainty or subject to this macro uncertainty, as well as some certain market news. That's quite normal for emerging market equity focusing on the growth stocks. This happens also in other portfolios. And the other part is about the liquidity risk, because as mentioned, for certain stocks, they may, particularly for those smaller stocks with smaller stocks, they may still subject to some liquidity risk, particularly for those investors investing in these directly investing in those names. But again, in order to mitigate those risks, we do have a diversified exposures, both from the stock level or from country level, or even from a foreign exchange level. So from this perspective, any single country or single stock or single FX drawdown may not impact the whole portfolio's performance that much, because we have a diversified exposure. And in order to mitigate this liquidity risk, we assign a dedicated equity ETF trading desk to help to leverage our existing network and also this the scale to try to lower these trading costs, and also help investors to liquidate their positions both at ETF level and at the underlying stock levels.
All right, thank you so much, Bruce, for those insights. This next question I really like. It's quite interesting. As one of your threshold is revenue threshold, would you like to check if these unicorns and high growth companies are already producing revenues? Maybe you can touch on the selection criteria.
Yeah, I think for the revenues, we have on the one hand, we try to broaden our definition in terms of the technology, because IT can be technology, electronic components or software can be technology. But again, we also define like car manufacturing, retail and media service as technology, as long as those sector, as long as a certain firm has revenue more than 40% of their revenue linked to those sectors we predefined. But for a firm or for a group which includes let's say multiple entities, let's say more than 25 underlying entities, we have an even stricter threshold. We define more than half or more than 50% of the revenue should be linked to these technology sectors or the technology related sectors. I think that's how we define this universe, because as we mentioned, we not only want to define this like a software index or IT index. We want to capture the region's growth as well as the region's manufacturing stories. So that's why we define these. We have a broad-based definition for this sector inclusion, but we still have a relatively strict revenue threshold here.
All right, thank you so much, Bruce. This other question from Tanvi. He or she is asking, what is ADR? Can you summarize, please?
Maybe I can read something from the Wikipedia, right? The term ADR, American Depository Receipt, they actually refer to a negotiable certificate issued by the U.S. depository bank, representing some specified number of shares. But actually, these ADRs can trade on U.S. stock market as similar to those U.S. domestic shares. I think the purpose for ADRs is mainly offer the U.S. investors a way to purchase or trade the stocks in the overseas companies that may not be available elsewhere. So I think this is the major purpose. But from our perspective, when we choose those ADRs, then as compared to those local markets, we still have some strict capital, let's say the capital control. Then we using an ADR or can definitely help investors to better access the liquidity and to protect the investors better.
All right, thank you so much, Bruce and Raphael. Raphael, any final words from you before we end the session?
Yeah, I just want to add a few things. It's more so for the guys out there in the market today. Definitely, it's not easy to navigate the current environment with elevated interest rate environment. Definitely, there will be poised of some risk out there. But nonetheless, if companies are already starting to diversify their portfolios, I think even for retail investors or individual investors like you and I, we should be looking at this spectrum as well. Definitely, the region will be of a space of growth for the next phase, albeit it may not be significant at this current juncture. A lot of people will be a bit wary, thinking about whether will this be a good option. But definitely, nonetheless, when we see that there's growth within the region and being a rule-based approach, you have the assurity that you don't have to pick a single company on your own. Nonetheless, it's more based on the rule-based approach, and you get basically the cream of the crops.
All right, thank you so much, Bruce and Raphael. I believe that's all the time that we have today. Thank you for joining us in the studio.
Right, thanks, Sri. Thanks, Philip Nova, and thank you all out there for joining, spending your evening with us. We hope that this has been proven useful to you. Just feel free to drop the guys at Philip Nova any questions that you may have. That you feel free, you are shy to post here. Just let them know, and they will just divert the questions over to us.
All right, there's still more time to ask questions. We have a post-webinar survey form. So if you have any other questions, you can type it in there, and I'll let Bruce and Raphael know what these are, and then we can attach the responses in our follow-up email tomorrow. All right, thank you for being a wonderful audience. Till our next live webinar. Take care, and all the very best in your trading this week. Have a great end to your week. Bye-bye.
Thank you.
Bye
Bye.
bye.